Let's talk about what's quietly becoming one of the biggest mortgage stories in Canada right now. You've probably heard about the 5-year COVID era mortgages coming up for renewal. The ones people locked in back in 2020 and 2021 when rates were unbelievably low. Those borrowers are starting to renew, and yes, their payments are going up. But there's another group of homeowners, and they might be in an even tougher spot. I'm talking about the Canadians who took out short-term 3-year mortgages back in 2023. These are the folks who thought rates are high now, but if I lock in short, I'll catch the drop when the Bank of Canada starts cutting. Fast forward to 2025, those same borrowers are now looking ahead at renewals in 2026, and they're realizing that the drop never really came. Rates haven't fallen the way everyone had hoped. Inflation stayed sticky, the economy slowed, and the temporary pain turned into a much longer squeeze. Here's what that means in real terms. They've been paying higher interest for 3 years straight now. But because it was a short term, they haven't had much time to build equity and pay down principal. Compare that to people who bought or did their mortgage in 2021. They had 5 years at ultra low rates to chip away at their balances and grow their home's values. Those homeowners built the cushion. The 2023 borrower, not so much. I read an article from a mortgage broker in New Brunswick, and she put it perfectly. We have two very different mindsets of clients with two very different equity positions and who have moved through different rate environments. And I have to agree with her that she's right. One group is walking into renewal with options. The other is walking in with anxiety. And as we move through 2025 and into 2026, the gap between those two groups is going to become painfully clear. Because for many Canadians, this isn't just about a higher payment, it's about whether they can even qualify to renew at all. And this is where the real renewal crisis begins, and it's only just getting started. So I want to talk about why some lenders are fighting to keep borrowers, why others are walking away, and what you can do right now to prepare before your renewal notice arrives. Let's break down exactly what's happening and who's feeling it the most, because when we talk about a renewal crisis, there isn't just one story. There are two completely different realities playing out at the same time. On one side, you have the 2021 borrower, the people who locked in their 5-year fix during the pandemic, and you got a rate somewhere around 1.5% to 2% range. These are numbers we may never see again. These homeowners had time on their side. For the last 4 or 5 years, they've been making payments that actually went towards principal. Their home values went up. They built equity, and they've got some financial cushion. Now, when those mortgages come up for renewal, yes, their rates might jump up to the mid-4s or even 5s, and their payments will definitely rise. But at least they have equity to work with. They can refinance, they can restructure, and they can extend amortizations to lower the monthly hit. It's not fun, but it's manageable. But then there's the 2023 borrowers. These are Canadians who said, I'll take a short-term mortgage now, ride it out for a couple years, and refinance when rates drop. They gambled on time, and time didn't cooperate. Because here we are in 2025, and the rate cuts that were supposed to save everyone, they've been slow and small. Now, the Bank of Canada took its foot off the gas, sure, but not enough to make a real difference yet. That means these borrowers have spent 3 years paying 5 or 6% interest, barely touching the principal. Their balance hasn't moved much, and their equity hasn't grown. So when they come up for renewal in 2026, they're walking into a buzzsaw. And again, remember that mortgage broker that I talked about. We have two different kinds of clients, one with equity and options and one without. For the 2023 group, refinancing might not even be on the table. Many of them will be facing what's called a straight switch, where they renew with the same lender instead of shopping around. And you might think that that sounds simple, but here's the catch. Lenders know that once you've locked in with them, they've got the upper hand. They'll fight to keep you. They'll throw competitive renewal offers at you, not because they're generous, but because they know that brokers can't easily beat those rates on straight switches, especially if your situation has changed. And that is the big part of the story, change. Over the last 5 years, Canadians' financial lives have shifted dramatically. People moved from salary jobs to contract work. Others became self-employed, started side hustles, and went part-time to balance family life. On paper, that means less stability, and less stability means it's harder to qualify for a new mortgage. So even if rates are competitive, you might not qualify to switch lenders. You might be forced to stay where you are, even if the terms aren't ideal. Now let's talk about those who've had an even tougher go. Maybe they've missed payments. Maybe their credit took a hit. Maybe their income dropped. For them, traditional refinancing may be completely off the table. These clients are looking at alternative lenders, or worse, facing the reality that their existing lender might not renew them at all. That's right, some homeowners are discovering that their lender simply won't renew their mortgage because their financial situation no longer fits the bank's policy. That's a scary phone call to get. And it's not just a financial story anymore, it's a human one. Imagine being told that the home you've worked so hard to keep might not be financed anymore. You can't just start over. This is the part of the renewal crisis no one really is talking about. The people who may not have a lender on the other side. Now here's where it gets even more complicated. Our household structure has changed since COVID. We're seeing more multi-generational homes, parents, kids, grandparents, all under one roof. And when those homes are financed on short-term, high-rate mortgages, it's not just one family affected, it's an entire support system. More Canadians have adult children still living at home because affordability is out of reach. Others have aging parents moving in because long-term care cost is too high. Mortgage renewals hit, the pressure isn't just financial, it's emotional. This is where that saying there's no one-size-fits-all solution comes into play. Every renewal conversation now feels like a custom-built plan. It's not about rates anymore, it's about survival. For some families, the strategy will be extended amortizations, maybe back to 25 or 30 years, to bring payments down to something sustainable. For others, it's about restructuring debt, rolling high-interest loans and credit cards into a mortgage to free up cash flow. And then there's those who simply need to bridge, a 1-year or 2-year term to buy time until rates come down even further. Every case is unique, and that's what makes this wave so challenging for brokers, lenders, and borrowers alike. Because remember, we've been talking about this renewal wave like it's a single event, but really, it's a combination of two very different storms. One storm is made up of people adjusting to higher payments, and the other storm is people wondering if they'll even have a mortgage to renew. And when those two collide, that's where things get messy. So if you're watching this and you have a mortgage coming up for renewal in the next 12 to 18 months, this is the time to start planning. Not when you get the renewal notice, not when the bank sends you a letter with an automatic renewal offer. Now is the time, because by the time that letter arrives, the decision will already be made for you. The renewal crisis isn't something coming, it's already here. And while the headlines keep focusing on the 5-year renewal, the real story might be the quiet pain that those 3-year borrowers who thought that they were playing it safe, but instead found themselves trapped between high interest rates and limited options. So now I want to talk about what you can actually do to prepare, how to avoid being cornered by your lender, what options exist even if your income or credit has changed, and how brokers are helping Canadians navigate what could be the toughest renewal cycle in a decade. So now that we've broken down what's really happening, what can you actually do about it? Because if you're watching this and your mortgage comes up for renewal, like I said, in the next 12 to 18 months or sooner, the worst thing you can do is nothing. This isn't a time to wait for your renewal notice and hope for the best. It's time to take control before your lender does it for you. Let's start with step 1. Know your timeline. If your renewal is within a year, you're already in the window where planning matters the most. Start reviewing your current mortgage details, your rate, your balance, your amortization, and your remaining term. You'd be surprised how many people don't even know their renewal date until it's too late to make a move. Step number 2, understand your equity position. If you bought in 2020 or 2021, you probably have some breathing room. But if you bought in 2023, you might not have seen the same equity growth. Knowing the difference changes the entire conversation because equity equals options. And if you're wondering what your equity position is, I've linked in the description a free home valuation report that you can sign up for, where you will get emailed monthly what the value of your house is and how it's performing in today's market. Step number 3, stress test yourself. Don't wait for your bank to do it. Run the numbers at 5 or 6%. Can you handle the payment? If not, what would it take to make it work? This is where brokers can help model different scenarios before renewal season hits. Step number 4, check your income situation. If you've gone self-employed, started contract work, or seen drop in hours, you'll need to prepare differently. Gather your income docs early. The earlier you prepare, the more options you'll have when it's time to negotiate. Step number 5, don't assume your current lender has your best options. That renewal letter you'll get in the mail, it's designed to make you say yes without asking any questions. But remember, silence equals profit for the bank. Always get a second opinion before you sign. Even if you stay with your lender, at least you'll know you're getting the fair deal. Now, for many Canadians, the strategy moving forward will be about structure, not rate. That could mean extending amortization to lower payments, consolidating high interest debt into your mortgage, or moving to a shorter term to stay flexible. It's not just about surviving this renewal, it's about setting yourself up for stability when rates finally normalize. And the good news, we're starting to see early signs of relief. Rates are edging down, lenders are competing again, and borrowers are becoming more proactive. But the ones who will benefit the most are the ones who start early. This renewal cycle isn't just about numbers, it's about people. It's about families who work hard to buy a home, now facing one of the most unpredictable lending environments in decades. And while there's no one-size-fits-all solution, there's one universal truth. The earlier you start the conversation, the better your outcome will be. So if you're feeling uncertain, talk to a mortgage professional now. Get your numbers reviewed. Find out what your options are before the renewal season hits. Because the renewal crisis isn't about fear, it's about preparation. And the sooner you act, the more control that you'll have over your financial future. I'm Justin Chaussee, and if you found this helpful, hit the subscribe button for more updates like this. And check the links below to book a call with me or a guide, like I said, that can help you find out what your equity is and what your equity position is. Let's make sure that you're ready before the renewal letter shows up in your mailbox.